Hi, and welcome to Midas Investing. Today we're going to be doing something a little outside of the normal box of the DCF approach we use here on the channel, and that is comparable pricing, or as it's often referred to in the industry as relative valuation. Whichever term you use, it's something that's often used in tandem with the usual DCF approach, and it's something I've definitely used quite a bit here on the channel, both in my videos and in my live streams. But in the last few months, I've refined my process down and built some new tools for it that have gotten me some pretty good results since the start of the year. Let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. Now, relative valuation, as it is often called in the industry, though I tend to prefer the term comparable pricing because I do think it is a process that it stands out pretty distinctly from the usual DCF process, and I prefer not to confuse the two. I get that naming system partially from Aswath Motoron. Now, the approach is to essentially take a look at a larger list of companies outside of just the one you're trying to analyze, companies that have something largely in common with each other within the same industry, within the same subsector of some form or another, and compare all the different market multiples that you can with the company, and ideally take into account some fundamentals as well to try to determine what would be appropriate multiples for the companies to trade at, given the industry that they operate within. And at the start of the year, as I said, I took a new approach where I decided I wanted to do this on a little bit of a broader scale. So what we're going to be doing here today is we're going to be taking a look at the S&P 500, breaking it down into the various sectors and doing a pricing analysis for each of those sectors, and then looking to see which companies stand out within there as possibly being significantly underpriced. Something to keep in mind when using this approach is that within each sector of the economy, there's actually a pretty large diversity of the types of industries that can be counted into one sector. And so that can get you some weird outliers that stand out just naturally because of the fact that you're comparing things that actually aren't really all that comparable. Good examples of this would be like in the industrial space, you have large manufacturers, but you also end up having some consulting services that count as industrials as well. But either way, I didn't want to break it down into too many different categories because it takes some time to actually work through all of this. And so either way, we just run with the 11 sectors that are traditionally thought of throughout the S&P 500. So first up that we're going to take a look at here is the industrial list right in front of us. I'm going to use this as my kind of guidestone to kind of show you guys exactly how this process works. So right here, first on the side, I have all of the companies within the industrial space of the S&P 500. Now, if you zoom in and take a look, you might find that there's one or two missing from the list, and that's because when I'm making these comparable analysis, I'm trying to actually work it down and make it so that there's a decent amount of relevant statistics between them. So if there's any weird outliers in some of the metrics, I will opt for removing a company from the list rather than allow the outlier to skew the whole process. What I mean by that is that what we're doing here is that we're comparing many different multiple metrics right here. For example, I have the PE ratio as well as the forward PE ratio, EV to EBIT ratio, forward EV to EBIT ratio, EV to sales, EV to forward sales on a two-year CAGR basis, EV to gross margins, price to book, EV to capital, as well as the dividend yield, which technically operates as an inverse multiple, all as my metrics of different multiples within the market that we compare companies to. And if, for example, a company has a PE ratio over 100, to me, that kind of starts to end up being a bit like an outlier and often skews up against, say, companies with multiples of like 10 to 20. And then likewise, we are using fundamental metrics over here to the right of revenue 2-year forward CAGR, according to analysts, gross margins, operating margins, tax rate, return on invested capital, net margins, return on equity, payout ratio, cash to market cap, as well as as well as debt to market cap ratios. And within that, we also might find that there's outliers as well. If, for example, we have negative gross margins or tax rates over 100%, or return on invested capital or return on equity that's like over 100%, I'll often opt to remove a company from the list rather than let it be in there. Though there's often sometimes exceptions that I leave in as well. Now, one of the reasons I opt for just using the whole sector, even though there is significant differences within the sector, is because with this statistical approach to looking through companies, you really want to have as large of a sample size as possible. Especially, ideally, I'm trying to opt for having at least a sample size of 30, which is generally considered to be a minimum statistically significant sample size within statistics. And if I can't get as much as that, well, we still kind of do the process. You'll see that a few of the sectors have a pretty minimal amount of companies within them. But nonetheless, like for example, here in the industrial sector that we're looking at, after the ones I've already removed, we still have a sample size of 70 companies. Some of them might be very, very different from each other, but nonetheless, it gets us the ability to average out some of the weirdness between any individual company and how that might skew the numbers. So coming down to this kind of middle section here underneath the fundamentals, what we do is that what I'm trying to look for is I'm trying to identify 3 specific multiples out of that list that I was just showing you that have the strongest statistical connection with each other, using R squared as my proxy for statistical strength. And then I look between that at all the different fundamentals, how that compares to each of those multiples, and then try to narrow in on 3 specific fundamental metrics that help boost that R squared as high as possible for each of those multiples. So we're essentially trying to use 3 fundamentals for each multiple 3 times over, which means we might end up having like 9 different fundamentals used, though there's often some overlap. For example, you'll see that the revenue forward CAGR is used twice here in this spot, the gross margins is used twice over here, and then all the rest of them ended up being different in this particular case. There's not really a problem with that because it is going towards different metrics. So in the industrial space category right here, we ended up using revenue 2-year forward CAGR, as well as tax rates, as well as debt to market cap level, and found that to correlate well with forward PE ratios, at least in the last period of time through which we're doing this. Now, speaking of period of time, this comparable analysis was actually done like a week and a half ago, and is done as of the reporting cycle in the first quarter, which is of the fourth quarter numbers. So all of these fundamentals are basically after all the companies have reported their fourth quarter numbers. And ideally, my goal is to try to do this on a quarterly basis going forward, though hopefully I'll be able to get it out a little bit more timely, not quite the 3 to 4 weeks late as it sort of is right now. I've had very, very busy last month or two in my own personal and professional life. And hopefully I'll be able to get to a little bit more of a regular schedule with this. My goal is to do this on a quarterly basis after all the companies, approximately speaking, have reported all their financials. I'll be using essentially all the companies in my portfolio as my proxy of when to do the process. So once the last company in my portfolio has reported its earnings in each earnings cycle, that's when I'm going to sit down and do these comparable analysis for all of the sectors. So anyway, back to the process. As I was saying here, we have the 3 metrics that I mentioned for the first one, which is correlated with the 4P ratio, but then we're also using gross margins, operating margins, and net margins in order to correlate with the forward EV to sales ratio, as well as the forward 2-year sales CAGR, gross margins, and return on invested capital for EV to invested capital ratio. Now, once I've done this, I come over to this right-hand section over here. For each of those multiple factors that I've looked at, we then use a very, very simple regression to try to say what would the under each of these fundamentals that we've selected of the 3, what would be the actual ratio that we say that it should be for each of the multiples. And then once I have all 3 multiples for each individual company, I essentially average them together, weighting them by the R squareds of each of the multiple type that we're using, and then use that compared to the actual multiple that it currently has to say how over or undervalued it is on each of these ones. And I do that for all 3 of the multiples. And then we come over and then we once again weight them by the R squareds to determine how over or underpriced the company is in general. So here in this particular column is essentially the end result, where we look at it as a ratio of it to its appropriate pricing level, not an over or under valued percentage. This is more of like a ratio. So if it was, you see a 100% right here, that means that it would be trading at basically exactly where the multiple says that it should be according to this process. So that's kind of where these end results are here. Now you'll notice that there's some colors highlighted for a few of these companies here. That's essentially me trying to sieve through it and look for the ones that really, really stand out. We're not just looking to see something that is 5% underpriced. We're trying to find something that's significantly underpriced, enough that it seems like there's something going on there. So what I do is I take a look at what stands out at the first quartile, the average with -1 standard deviation, and the average -2 standard deviations, which in this particular case means anything that's at the 73rd percent ratio relative to its pricing, 59% of its ratio, and 26% of its ratio. and I color them accordingly, with the orange ones being under the quartile, the green ones being under 1 standard deviation, and then purple, if there is any, is under 2 standard deviations, which you'll notice for this particular industry, there isn't actually any in that third category. Now, once I'm done with that process, I like to come over here and make graphs for each of these. For each of these graphs, what I do is it's a one graph for each of the multiples, but then I narrow in on which out of the 3 of the fundamental metrics that had the strongest statistical relationship with it, and then make a graph out of it. So in this particular case, we have forward P versus the forward revenue CAGR, and you can see that there's a pretty strong relationship right here. The R share wasn't necessarily super impressive, but we can see it very, very clearly on the graph that there's a nice positive correlation between the higher that the revenue CAGR is expected over the next few years, the higher the forward P that it's going to be right here. Now, I do cut off the barriers of the graph for each of these graphs to narrow in as best as I can on the actual center of the mass. I allow for companies to essentially be off the map, so to speak, as long as they're above the line, because really we're trying to look at things that are below the line, because that's the things that are underpriced. And each of these graphs are going to be different. We're going to be zooming through a lot of these graphs in pretty rapid succession. So we're not really going to be staring at these too long. I'm just kind of showing you the results of it. But then we're going to go to a more comprehensive list where I have all of those best selected companies all together. That will be something you can look at a little bit more closely. So this is the first one. And then for industrial still, we have the EV to forward sales versus operating margins. You can see nice, strong, positive correlation. Going over to the third one, we have EV to invested capital versus return on invested capital. Nice, strong statistical relationship. Then on the fourth graph is where I essentially combine all of them together. Though in this particular graph, it uses all 3 of the fundamentals. Once again, this is just the general pricing ratio that I was talking about, which is the end result right here. But then the metric that I compare that to is actually the logarithmic scale of market cap, because I do in general find that larger market cap companies tend to have higher multiples than smaller cap companies. And so I like to represent that relationship a little bit right here when I'm taking a look at the companies on a logarithmic scale, so that we can look at them all nice and neatly and together, rather than have them very, very separated apart by billions of dollars of market cap. So this is the whole process right here, all for the industrial spaces I was talking about. We'll now go through all the other sectors. Coming over to the financial sector, we can see the first graph that we put together is for the forward P ratio as well as to the forward revenue CAGR. You'll see a lot of the same repeated relationships for a lot of these metrics on some of the sectors. See still a very nice positive correlation. Then for the second one, we have EV to sales versus net margins in this particular case. Then we have price to book versus return on equity. And then the all-in graph right here. One thing I would note is that for not every sector do we actually see a positive relationship between the pricing ratio that we come up with and the market cap. That's true, at least to a slight degree, for the majority of the sectors, but there are a few exceptions to that, financials definitely being one of them. Then coming over to the healthcare sector, this one's definitely a sector that has some significant differences between its different sub-industries as well. The first graph, we have the forward P versus revenue CAGR, a pretty nice even relationship here. Also then EV to forward sales versus operating margins, pretty nice as well. Coming to EV to invested capital versus return on invested capital, a nice positive relationship as well. And then coming over to the final graph, still a positive relationship for this one for the market cap as well. Then likewise, coming over to the technology sector, we have PE, the normal PE versus gross margins, which is pretty interesting that it comes to the gross margins ones versus some of the other margins instead. We have EV to sales versus forward revenue CAGR, as well as price to book versus return on equity. And then the all-in ratio coming in right here, a little bit more of a stronger pile of the companies here at the smaller cap end of the scale for technology, which is interesting. Then we come over to the discretionary sector, and we have forward PE versus revenue forward CAGR. We have forward EV sales versus operating margins, as well as EV to invested capital versus return on invested capital. Pay no attention to the companies that are colored different things right here. That's kind of a layover from some of the early process when I was putting these graphs together. There's nothing significant about that. I've noticed a couple of those there. I must have forgotten to change. And then the all-in ratio right here. This is a perfect example of what I was talking about, where you might notice that the things seem a little bit skewed. Like, for example, this line is going well above the larger mass of companies right here, and that's probably because there's some outliers are off the map over here. But like I said, I try to narrow in more on the companies that are below the line. And while the line is useful to look at, it's not necessarily super representative because the ratio itself still is based around kind of a 100% point. So this is kind of like where the 100% line would be if you were looking at the y-axis. Then coming over to the consumer defensive sector, we have EV to gross margins versus net margins. Interesting that this one diverges from some of the popular metrics that we saw for the other sectors so far. Then we also have EV to forward sales versus gross margins on this one. Then we have price to book versus return on equity. Then the all-in graph for this one as well. Coming over to the real estate sector, we end up with EV to EBIT versus revenue forward CAGR for this particular graph. Then we have EV to forward sales versus gross margins. Then we have EV to capital versus return on equity, the all-in graph over here as well. You can see that the sample sizes are starting to get a little bit smaller as we go down, and that is because I did start by showing you guys the sectors that have the largest sample size, and we've kind of been working our way down towards the less sparse sectors of the S&P 500. Then coming over to the utilities sector, we have forward P ratio versus debt to market cap. Now you'll notice that this one has a negative relationship for the line, and that's because it's debt to market cap. So there is a few metrics that do have more of a negative relationship that I'm specifically looking for, and that is things like the debt to market cap as well as tax rates, because as those things go up or down, it actually has an overall net negative impact on the actual equity flows that come to a company, and therefore the actual value of the equity for any individual company. So if we see debt to market cap as a ratio going up, we would expect them to trade at a lower multiple. So it is one of the few fundamental metric cases where you would expect to see a negative correlation instead of a positive correlation. Then we have EV to sales versus operating margin, nice relationship there as well. EV to capital versus debt to market cap, likewise, we can see a negative relationship. Pretty interesting that the utility sector, two of the strongest relationships we found were for the debt to market cap. So something to also pay attention to when you're looking at these is like what seems to stand out as an important metric for this particular sector. Well, in the utility space, they're very, very heavily loaded up on debt since they're a lot of fixed assets on a very long-term basis. And so perhaps investors are very sensitive to just how large those debt loads can be. Coming over to the final ratio right here, you can see still a nice ratio right here. Then coming over to the basic materials sector, we can take a look. The first one has EV to capital versus forward revenue CAGR. Very interesting. This one has a decent amount of companies way over in the negative space. So some negative revenue CAGRs expected in the material sector, according to analysts, based off of these metrics right here. Then we have EV to sales versus gross margins. Then we have EV to capital versus return on equity, and then the all-in ratio over here on this one. Pretty strong positive relationship for this particular one. Then we come over to the energy sector, the first one of which we have dividend yield versus payout ratio, which is pretty interesting on this one. This is one that's kind of interesting to pay attention to. The dividend yield is one that I try not to use under many circumstances because a lot of companies in various sectors don't actually have a dividend yield. And so I try not to use a metric unless it's actually going to apply to the majority of the companies in the sample. But there are some sectors where that does end up being a pretty good option to go for. And it's worth noting right here that a dividend yield, you would expect the reverse because of the fact that it's an inverse effect. So with this one, against a normal fundamental, you would expect it to be a negative relationship. But likewise, payout ratios are something that where you would also see an inverse, similar to the debt to market cap or tax rate. So because of the fact that both of them are inverses, that means we actually end up with a positive relationship here. A dividend yield would be higher as a payout ratio goes up, both because a payout ratio is directly related to the dividend yield in the first place, but also because that means that there's less cash flows for the growth of the company, and then the yield going up means that the price is going down. So you would actually expect to see this type of relationship. Then we have EV to forward sales versus operating margins for this one, as well as a price to book versus debt to market cap. But likewise, here's the end result with this one. And this is the other example I was thinking of when I said that there actually doesn't seem to necessarily be a direct relationship between the market cap and the end pricing ratio. There may be lots of arguments you can make for why that's the case. Like I said, energy sector is a bit more like the base material sector in a lot of ways, but there's also a lot of interesting ways and dynamics in which they operate. Perhaps the larger market cap ones are much more are much more mature and therefore have much less growth prospects and are much more of like just a straight valuation prospect, versus some of the smaller companies might have a much more of a speculative approach to them, which means people might be willing to pay higher multiples for them. That's just one argument you could potentially make for why you see this kind of relationship for this particular sector. Then last but not least, we have the communications sector. Coming over to take a look at the multiples of that, we have forward PE ratio versus forward revenue CAGR. Nice, strong relationship. It's worth noting that this is the last of the sectors, and man, is the sample size really getting pretty sparse for this one. And I also point out that there's also some pretty significant differences in this sector as well between companies like Google and Meta and even Netflix versus things like AT&T and Comcast and Verizon. So always take that with a grain of salt when you're looking at these graphs, is that there is some pretty significant differences between the companies in the sample, and then the sample size itself is pretty small as well. Then we have forward EV to sales versus net margin. And then for the third one, we have EV to capital versus return on invested capital, a much better relationship. And then the all-in ratio we have right here. All right, so that's it. We made it through all 11 of the sectors of the S&P 500. So coming over to this final little sheet that I have right here, where we can have essentially the final results, where I've listed all of those companies that are either at the first quartile, which makes it better than essentially 75% of the companies in the pricing analysis, as well as the average -1 standard deviation, as well as the average -2 standard deviations. Here on the left-hand side, I have listed each of the sectors where each of the company groups are, and you can see like which category it falls into right here. Now, it's worth noting that if something falls in the average -1 standard deviation category, that means it is in fact also in the first quartile category too. It's just actually a little bit better than that. And then likewise for the second deviation category, though there isn't a lot of companies that actually fall into that in this particular analysis. Now I do list here also the number of companies that are in each of those samples, and this is after I've already gotten rid of some of those outlier companies. So in the financials, we use 72 companies for our analysis, and you can come down the list to see like those last few I did there. Communication only had 19 companies in its analysis. So as I said before, in general, in statistics, you really want a minimal sample size of at least 30. So there is at least 3 sectors here that don't quite hit that mark, but nonetheless, we do the best with what we can with this. And then likewise, I've also added up all of the companies together, so you can see that out of the 500 or 502 tickers, depending on how you want to think about it, I don't use repeated tickers as well. So it would be technically 500 companies or so. You can see we ended up using 486 out of them. And then I have these percentages up here, which tell you essentially like what percentage of the companies managed to make it into each of those categories. So for the first quartile category, like I said, it technically includes all 3 of these categories here. 22% of the companies ended up falling into the first quartile. 10 to 11% that falls into this category, and 0.4% that falls into this category. So looking through them, you can take a look for yourself. I tried to make the font size large enough that you could perhaps pause and take a look at each of the companies that fall in this category. Now, the point of doing this approach is not to necessarily go out and buy these companies because they're underpriced. The reason why I like this approach in general, as kind of like an additional factor when doing my valuations, is that for 2 reasons. One, if you already think a company is undervalued on a cash flow basis, and then you find that it has a significantly underpricing after taking into account lots of fundamentals, then I take a look at that as almost like an icing on the cake to the valuation. It's like an extra factor that works in your favor, and you can even think of it almost like a potential catalyst of sorts. It's almost like one other way that other investors could potentially realize the value that you've done, the DCF value that you've done, and it can perhaps speed up the process for getting some results for that valuation, for the market starting to realize that, oh, wow, this company is actually underpriced. If you look at its fundamentals, then maybe other people might be buying up those companies and perhaps even shorting the ones that are overpriced. So that's certainly not something I'm going to be doing here. So I think of it as like an extra factor, like almost a small catalyst that can work in your favor with the DCF process as well. And then likewise, the other reason I like doing this approach is that this is a good way to sift through companies for companies to look for where valuation might exist. And that's what I did at the start of the year when I did this process last time. And I did share a lot of the results of this in one of my live streams. And this is one of the reasons I want to do this on a quarterly basis, is that I think this is perhaps a good way to sift through companies on a quarterly basis with the new quarterly earnings to say, okay, which companies should I maybe be trying to look and see, do I like these business models? And then if I like the business models as well, then maybe I should do a valuation for them as well. And that's worth noting because actually the last 3 valuation videos that I put out, that being Mosaic, Heidrick and Struggles, and Silvercore, all three of those companies came out of this pricing process. And I was actually very, very satisfied with the results of the DCFs that I made for all three of those, as well as I got some pretty quick results in terms of returns from each of those companies as well. So I think that this is actually a pretty fruitful process in terms of getting the right companies to value, finding interesting companies to value, and then also getting some good returns out of it on a relatively quick basis. So anyway, enough with that. We can go through the list. In the first quartile for financials, we have BAC, WFC, CB, AIG, COF, TRV, PRU, RJF, SYF, GL, AIZ, CMA. In the second in the second category, which is average minus one standard deviation, we have MS, ACGL, MTB, and EG. Now, I'm not necessarily going to go through and name off all the tickers in all those categories because that'll just be me spouting off a lot of letters, but we can come down to each of these categories. Industrials, we had 70 companies to look at. We ended up finding 10 companies in the first quartile. When you see the mark with this color right here, that should be an indicator to you that that's actually a company that I have in my portfolio already. But then in the average minus one standard deviation, we have 7 companies. Coming down to healthcare, we ended up having 10 companies in under the first quartile, as well as another 5 of them that's under 1 standard deviation. Technology, we ended up finding 4 companies under the first quartile, as well as 10 companies under the 1 standard deviation category. And it's worth noting, as you can see right here, that there isn't necessarily some special rule where there's going to be less in this category than there is in the first category, because as I said, the first category technically includes everything in all 3 categories, and then the second category technically includes everything in the last 2 categories. I'm just listing them in these different columns so you can see where the minimal cutoff for each of these companies is, because essentially the ones in this column would be the most underpriced companies to look at, and this would be some also pretty significantly underpriced category companies, and then these ones are still pretty significantly underpriced, but just not quite as good as in the next category. So it's really just like you should opt for looking at these companies first, and then if you don't find anything fruitful to maybe do evaluation on, then maybe look at this column and these categories, and then if you don't find anything fruitful there, or maybe you've already done some evaluations there, then maybe move on to the ones in this column here. That's essentially the idea of why there's 3 different columns here. Coming down to consumer discretionary, we can see we have 7 companies in this particular first quartile category. Then we also have 5 companies under 1 standard deviation. Coming down to con defensive, we actually ended up only finding companies under 1 standard deviation, though like I said, that means they do technically fall in under the first quartile, but 6 of which for consumer defensive. Then for real estate, we end up finding 4 companies at the quartile, 1 or 2 companies at the under 1 standard deviation range, and then 1 company that falls under the 2 standard deviation range. So very interesting. Perhaps there's something going on there. I do think when I did this analysis last time that this one also fell into that category as well, but I think for one reason or another, I decided that I didn't really like the business model, because you should definitely be taking everything into account. Just because something's underpriced doesn't mean it's a good option to look at. Sometimes there's a reason it's underpriced. Utilities, 4 companies under the first quartile, 1 company under 1 standard deviation, and then 1 company under the 2 standard deviation. Materials, we have 2 companies in the first quartile, 3 companies in the 1 standard deviation, and there's Mosaic, one of those companies that I identified last quarter when I was doing this approach. And then in energy, we have 1 company under 1 quartile and 4 companies under the 1 standard deviation. And communication, last but not least, we have 2 companies under the first quartile and 2 companies under the 1 standard deviation. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's the entire approach for my pricing analysis, or relative evaluation, whichever term you prefer to use for the approach. As I said, I'm going to be trying to do this on a quarterly basis, and now for the next couple of weeks, I'll be definitely sifting through all these companies and trying to identify which business models seem the most appealing to me, and then running some basic DCFs on a bunch of them to see if I can identify some value. And then once I find companies that I think are decently underpriced as well have some reasonable value, at that point I'll definitely be diving in and perhaps making some models out of them. Maybe you'll see some videos in the near future coming out of those. All right, I'll catch you all in the next video. Bye.